Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is spearheaded by ICICI Prudential Asset Management Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. The contents of the discussion should not be construed as Outlook Money's editorial recommendation. I'm Versha Jain from Outlook Money and your host for the session. Welcome to another episode in the series where we break down the complexities of the financial world and give you insights that can potentially make a difference in your financial well being. Today's episode is brought to you in association with ICICI Prudential Asset Management Company Limited. Our topic for discussion today is Lakshmi's Choice Prosperity Through Gold ETFs. Gold is the flavor of the festive season. As investors seek stable and innovative investment options, gold ETFs emerge as a beacon of security in volatile times. In today's podcast, we'll delve deep into the world of gold ETFs, understand their significance, and how you can incorporate them into your investment portfolio. We will discuss more about gold ETFs, their popularity, and significance in the portfolio. To delve deeper into understanding gold ETFs, today we have with us Mr. Chintan Haria, Head of Product Development and Strategy at ICICI Prudential AMC, who will provide insights into this glittery metal and gold ETFs in particular. To begin with now, please tell our listener what a gold ETF is and how it differs from other forms of gold investment like physical gold or digital gold.
Sure. When we look at historically, Indians have been investing in gold in the form of physical gold, be it jewelry or coins or bars. About 15 to 18 years back, gold ETFs were launched in India, and they gave an option to the investors to invest in the financial form, in the form of gold ETFs. Also, sovereign gold bonds, which are issued by the government and RBI, are available as an option for investors to invest in gold for the long term. What sets the gold ETF apart is that one, it is on the exchange. You buy and sell it with the ease with which we buy and sell stocks. It is available in smaller units. If typically you go out and you want to buy physical gold, the ticket sizes would be slightly larger. It could run into thousands of rupees. While in the case of gold ETF, one unit you can buy and the unit cost could be I think most of the AMCs have unit costs of less than 100 rupees for their gold ETFs. So it's based on unit, and investors can take advantage of accumulating these units as and when they have the funds, and then ultimately taking the advantage of creating a corpus in gold ETF. Gold ETFs are transparent way of investing in the markets. Their prices are well discovered and very close to the international markets as converted into Indian rupees, adjusted for the taxes. And from an investor standpoint, instead of having to basically handle physical gold, which requires security, which you have to worry about purity, here in the case of gold ETFs, the money which you invest in ETF, first of all, gold ETFs are well regulated in India, much like all mutual funds. And at the back of the gold ETF is a physical gold of highest purity, which is as per the standards laid out by the regulator. And this gold, which is of the highest purity, is stored in molds which are approved as well. So the security, the purity, the ease of transaction are some things which make the gold ETF a good choice for investors looking to accumulate gold as an asset class for the long term.
Okay, so ease of use while investing in gold. Please throw some light on the gold prices determination. How are gold prices determined and which gold price is considered for ETF valuation?
So if we look at prices of gold, in the case of gold ETF, there is a well-defined formula which is well tabulated in the SIDs or the scheme information documents. That is the domestic landed price of gold, which is very close to the prices at which gold is available in India and the domestic markets. There are at times physical premiums and discount which do occur in the in the real world, which are well reflected in the gold ETF prices as well. So from an investor standpoint, to put it simply, the gold ETF prices on the exchange reflect more or less the prices
Mhm.
of gold which are there in the markets in India, in the domestic markets. and the ease with which you can buy and sell without having to worry about making charges, without having to worry about leakages as far as transaction costs are concerned, beyond what you normally do as far as your buying and selling of shares is concerned, are few of the advantages that you get when you execute through the gold ETF. The pricing mechanism is quite transparent, and it is available for everyone to see in terms of they are simply the prices of the domestic gold which is there, and AMCs, market makers, authorized participants, all of them work towards making the gold ETF efficient and a good way for investors to invest in ETFs.
All right, while the price mechanism is now clear as in the domestic market, whatever is the gold price, ETF also offers the same. How there is still a confusion about in gold ETFs and gold funds. So how are they different, gold ETFs and gold funds, in terms of investment assets?
Normally, gold ETFs and gold funds are spoken interchangeably, but if I have to make it simplified, gold ETFs are the one which you buy and sell on the exchange. It is essentially the gold fund of funds, which basically invest in the gold ETF. So there are two types of investors. One investor who does not have demat account and one investor who has a demat account. Now, for those investors who have a demat account, they can basically simply go on the exchange and buy the units on the exchange for the gold ETF. However, if the investor does not have a demat account, then the investor may have to go through the route of gold funds. Gold funds are nothing but gold mutual funds or gold fund of funds as they are commonly called. And gold fund of funds, when you put a money, it's like a mutual fund. When you put a money in gold fund of funds, that gold fund of fund will in turn put money in the gold ETF. So if you don't have a demat account and you want to participate in gold ETFs, the way to do it is put your money in gold fund of fund or gold fund, and that gold fund of fund will in turn invest in the gold ETF. You don't have to do much in that. You just invest in the gold fund. The gold fund, which is managed by the asset management company or the mutual fund, will in turn invest in the gold ETF. So ultimately, the money goes into the gold ETF itself. Just that for those investors who have a demat account and want to trade it on the exchange, do it in the gold ETF route, and those who do not will do it in the gold fund route. Thank you.
Okay, so it's just a layer in between. If one is going through gold ETFs, is direct investment, and while choosing gold FOF, funds of funds, one layer is added because they will invest in ETFs, which further invest in gold. Is it so?
That's correct. Thank you for simplifying it. You got it right. Thank you.
Can you also walk us through the process of buying and selling gold ETFs? Is it similar to trading stocks?
Yes, absolutely. So gold ETFs, much like how shares are traded on the exchange, are also available to be bought and sold on the exchange at real time, on real time basis, at real time prices in multiples of 1 unit. So you can buy as low as 1 unit, and then you can buying and selling is quite easy, much like how you do a share, as long as you have a trading account and a demat account. Thank you.
Okay, one more thing I want to clarify here. How does the price of gold ETFs reflect the current market price of gold, and how frequently it is updated?
If you look at the real-time prices on the exchange, the buying selling happens between buyers and sellers who are on the opposite sides. And there is also an authorized participant or a market maker who ensures that the pricing of the gold ETF and the traded price of the gold ETF on the exchange are very close to the prices of the domestic market availability of gold. So there is a linkage which is created, and that linkage is ensured by the efficient market making mechanism which the authorized participants put in place. And all AMCs who run gold ETFs would endeavor to have their authorized participants to have this efficient pricing mechanism, wherein the investor gets as close to the real-time prices or as close to the domestic prices of gold are available for them to trade on the exchange. So that is how the linkage is. We've seen over the last many years that gold prices have been a reflection. And as far as the frequency of update is concerned, if you look at on an exchange basis, the prices are on real time. So literally on tick by tick or on trade by trade, the prices basically are reflective of the gold prices that are there on the markets. Thank you.
According to you, what should be the ideal percentage allocation to gold investment in a portfolio?
If we look at overall investment in financial assets in India, that is increasing. Within the asset allocation plan of an investor, generally, when you are looking at asset allocation, we suggest that at least 10% should be allocated to commodities and bullion or gold and silver. And if an investor wants to invest more, they are most welcome. But given the current scenario wherein there is global uncertainty, interest rates globally are high, valuations of equity markets are not cheap, we do believe, and currencies are losing value because of inflation. We believe that investors should look at having at least a 10% allocation to gold and increase it, because over the last many years, we've noticed gold allocation has come down for investors. So look at your overall allocation, and we suggest probably having somewhere around 10% or more than 10%, also depending on the investor's risk appetite, should be allocated to gold, because it's an asset class where we believe that it can provide uh, a cushion against possible volatilities in the near future. Thank you.
Okay, so 10% is what you are suggesting to have exposure to golds in the portfolio. And what could be the maximum limit? Or is it a range somewhere?
There is no maximum as such, but typical diversification of assets suggests that anywhere in the range of 10 to maybe 25%, you can have bullion as part of your portfolio. Now, for example, if you have equity exposure which is high, you are a risk taker, then you necessarily may not want to have too much allocation to debt. So you balance residual allocation, you can have to gold. So 75% equity, 25% gold for those investors who are risk taking may work out. For those investors who are conservative, they may have only 25-30% equity. They may have 50-60% in debt, which is the traditional investment route which investors have. For them, maybe 10% gold is what would fit in their portfolio. So there is no minimum maximum range as such, to be honest, and there's no scientific basis around it. But from a diversification perspective, we do suggest that anywhere in the range of 10% to maybe 20% can be looked at in terms of allocation to gold and precious commodities. So gold plus silver put together, maybe 10% is a good number. And if you want to probably have a more diversification in bullion, then gold plus silver can be as high as 20%. But that depends on investor to investor and their circumstances in terms of what are the other asset classes and what are the percentages of other asset classes that those investors have. Thank you.
Okay. And if one has gold in the physical form, such as jewelry, should it be considered a part of the portfolio asset? Because then there may not be a need to invest in gold ETFs for diversification.
If we look at in the cultural and the traditional sense in India, jewelry, which is considered as Tridhan, is not meant to be accounted for as part of your allocation. It is meant probably in times and in bad times that can be used as a means of generating some residual cash, or you basically residual money that you need. But otherwise, we do not buy jewelry for asset allocation. We buy jewelry for protection or security, and it's not to be considered as part of asset allocation in my view. So jewelry, we can keep it aside. It's meant to be Sridhan. But apart from jewelry, yes, if you have sovereign gold bonds, if you have physical gold bars or coins, which are part of your asset allocation, which you bought as part of allocation, and even gold ETFs, that is the amount that you should consider. I would probably want to leave aside the jewelry, because technically in India, at least from a cultural fit perspective, it is considered to be a Tridhan, and we do not necessarily sell it.
Okay, so this means that all type of gold is considered under the portfolio allocation except jewelry. So gold in the form of bars, coins will also be considered under portfolio.
Theoretically, yes, but if, for example, someone has kept gold bars or gold coins for the purpose allocated towards maybe a daughter's wedding 10 years down the line, then I would want to probably exclude that as well. So again, it depends on each individual and the reason for which they've bought that. So only those allocations where you can actually sell, or you will actually sell to raise money, I would consider as part of the gold allocation which I have. If you have allocated or bought gold bars or coins for a specified purpose later on to be given as a gift to the daughter-in-law or to the daughter, I wouldn't consider that as part of gold investments.
Okay, thank you for clarifying this. Lastly, my question is that could you explain the future outlook of gold and particularly the gold ETFs?
If I look at gold ETFs or gold in general as a commodity, given the world has increased debt, increased interest rates, increased equity valuations, gold is a asset class which probably is now garnering attention of investors as well as central banks. The latest World Gold Council report, which basically speaks of how the second largest economy in the world has been one of the biggest buyers of gold and is continuously buying gold. So it is central banks which are buying gold, and individuals also probably will look to add gold over a period of time. So as a safe haven investment, as a hedge against inflation, as a store against the depreciation of currencies, we do believe gold is something which should be looked at. And yes, it has a future which is quite good in terms of if there is uncertainty in the world, it can potentially act as a risk hedge. So not only in terms of the absolute upside which may come as a risk measure, as a risk mitigation measure also, gold in your portfolio will bring a good balance is what we feel. So it's not always we try to capture upside that may come, but yes, as a portfolio diversification and as a balancing mechanism to the overall portfolio, gold should be a good fit. Thank you so much.
Thank you so much, Mr. Haria, for joining us today. Our listeners are sure to benefit from the insights and details discussed in this episode. With this, we come to the end of today's episode of Investment Made Easy podcast. Listeners, we hope you enjoyed our conversation today. Please don't forget to share your comments and feedback on this episode. You can also share your suggestions and questions at letters@outlookmoney.com. We'll be back soon with our next edition. Until then, stay informed and keep following Outlook Money, your personal finance magazine.